On October 31st, 2025, the Federal Reserve's standing repo facility was used for $50.35 billion in a single day, a clear signal that the financial system's core plumbing was under stress. By the end of this video, you will understand what these signals mean, what is happening inside the banking system, and how it relates to the choice between two very different financial networks. The financial system we use every day is built on trust in large, established institutions. But behind this image of stability, strains are showing. The traditional banking system is quietly growing more reliant on liquidity from the Federal Reserve to keep markets functioning smoothly. This isn't a theory, it's visible in the Fed's own data. While headlines focus elsewhere, the real story is in the financial system's plumbing, in mechanisms like the overnight repo market and other official liquidity facilities. Once reserved for rare emergencies, these tools are becoming a more regular feature of the system. The banking sector now leans on a consistent source of liquidity, and the Federal Reserve is the provider. In stark contrast stands Bitcoin, a financial network built on mathematical proof and absolute transparency. It has no central bank to create money or support specific institutions. Its rules are written in open source code for all to see, and it operates without needing a liquidity backstop. This video is about the divergence of these two worlds. We will look at the official support mechanisms keeping the legacy banking system operating. We'll follow the data to see how reliant the system has become on this support. And we'll connect the dots to explain why this dynamic is contributing to a significant capital shift, out of a system defined by intervention and into one defined by transparency. To understand today's situation, we have to look back at the events of 2023. The failures of Silicon Valley Bank and Signature Bank were not isolated incidents, but symptoms of a deeper issue. Banks held long-term government bonds that lost significant market value as interest rates rose, creating massive unrealized losses on their balance sheets. In response, the Fed created the Bank Term Funding Program, BTFP. The concept was simple. Banks could post their devalued bonds as collateral and receive cash loans valued at the original price of the bonds, not their lower market value. This allowed banks to access cash without selling assets at a loss. The BTFP was a temporary measure that restored stability, and it closed as scheduled in March 2024. But the underlying vulnerability, that banks held trillions in assets worth less than their stated value, remained. By late 2025 and early 2026, the need for liquidity resurfaced, and the usage of official liquidity tools surged. The primary tool now is the Standing Repo Facility, or SRF, established in 2021. Think of it as a permanent liquidity window for banks. In a healthy system, this is used sparingly, but recently it has become a critical lifeline. This support happens quietly, through financial plumbing that operates outside of public view. The banking system is no longer standing entirely on its own. Here is the evidence, in plain English. On October 31st, 2025, firms borrowed $50.35 billion from the Fed's Standing Repo Facility, a then record amount. On December 10th, 2025, the New York Fed announced that standing overnight repo operations would become a full allotment facility, removing the aggregate operational limit. And on December 31st, 2025, year-end borrowing from the facility hit a new record, $74.6 billion. To be clear, repo usage can spike for routine reasons at the end of a month or year. The story is not one single day's event. It is the pattern of increasing reliance on official backstops whenever the system experiences stress. If the financial system is receiving this much liquidity, the next question is, who is using it? By design, that information is not public in real time. This is a key feature of the modern financial support system. The Federal Reserve does not disclose which specific banks are using its liquidity windows as it happens. That data is released with a lag of up to 2 years, long after it would be useful for immediate market analysis. This secrecy is intentional. The rationale is that if the public knew a major bank was borrowing billions overnight, it could trigger a crisis of confidence and a potential bank run. To prevent this, the Fed provides liquidity discreetly, allowing institutions to project an image of health. The primary users of these Fed facilities are a select group of large financial institutions known as primary dealers, which sit at the center of the financial system and interact directly with the Fed. This structure is designed to maintain stability by allowing system managers to address liquidity shortages behind the scenes. What we are witnessing is not just a crisis intervention, but a structural change in how the financial system operates. The Fed was traditionally known as the lender of last resort, a fire extinguisher to be used only in a true emergency. Today, that extinguisher is being used more regularly. The key tool is the standing repo facility. The name itself is telling. It's not an emergency program, it's a standing facility, created as a permanent market feature in 2021. This implicitly acknowledges that the banking system may no longer be able to reliably fund itself without an official backstop. But what exactly is a repo? It's short for repurchase agreement. A bank needing cash hands over assets, usually US Treasury bonds, as collateral. The Fed provides the cash. The next day, the bank repays the loan with interest to get its collateral back. In a healthy market, banks conduct these transactions with each other. A problem arises when banks become hesitant to lend to one another, causing the private market to freeze. At that point, they turn to the one entity that can create limitless cash, the Federal Reserve. This reveals the critical difference between being solvent and being liquid. Regulators may argue these banks are solvent, that on paper their assets exceed their liabilities. But a solvent institution can still fail if it runs out of cash. That is a liquidity crisis. The Fed's repo facility allows banks to get cash without selling assets and realizing major losses, helping them manage liquidity stress. This is the modern banking system. It appears stable, but it is highly dependent on a central bank now tasked with providing regular support. This brings us to the final piece of the puzzle. As the support mechanisms in traditional finance become more active, observers are making a rational choice. They are opting into a different system. This is a narrative-driven shift of capital away from a system of dependency and into one of mathematical certainty. Investors are increasingly looking to Bitcoin as an alternative to a system they are questioning. It is becoming an insurance policy against the fragility of the traditional financial infrastructure. Bitcoin is no longer just a hedge against inflation. It's a hedge against counterparty risk. To understand why, contrast its properties with the system just described. First, there are no bailouts in Bitcoin. The network runs on strict, unchangeable rules. There is no central entity to save a reckless lender. The system purges risk instead of hiding it. Second, Bitcoin is permissionless. You do not need approval to use it. Anyone can download a wallet and become their own bank, offering true financial sovereignty. Third, the Bitcoin network is radically transparent. Every transaction is recorded on a public ledger that anyone can audit. The total supply is known and the flow of funds is visible. There are no hidden liquidity injections. It is an antidote to the opacity of the traditional system. Finally, Bitcoin has verifiable scarcity. The Fed can create billions of dollars with keystrokes. There will only ever be 21 million Bitcoin. That number is enforced by a global network and cannot be changed by a committee to rescue powerful institutions. This absolute scarcity makes it a compelling store of value in a world of elastic currency. The market is realizing Bitcoin is a parallel financial system, a resilient alternative to an incumbent system that is proving it cannot always stand on its own. What this means and what to watch. So what are the practical takeaways? Here are 3 things to consider. Signals to watch. Keep an eye on the usage of the Fed's standing repo facility and the discount window. Consistently high numbers especially outside of predictable month-end spikes, are a key indicator of liquidity stress in the banking system. How Bitcoin behaves. Historically viewed as a risk-on asset, Bitcoin's behavior is evolving. As indicators of banking stress have risen, capital has often rotated into Bitcoin, which is seen as an asset with no counterparty risk. Reducing counterparty risk. Without giving financial advice, it is wise to understand where your assets are held and the risks associated with your custodian. Diversifying how and where you hold assets is a fundamental principle of risk management. If you're starting to see the financial world in this new light and want to keep learning about these deep-seated shifts, make sure you subscribe. We cut through the noise every week to bring you the real story. And I want to hear from you in the comments. Do you think these official support mechanisms can manage banking stress long-term? Or are they a temporary solution? Let me know your thoughts. So here is where we stand. On one side, we have a legacy banking system that appears strong but is becoming increasingly dependent on a constant flow of liquidity from a central bank. It is a system characterized by opacity and intervention. On the other side, a growing alternative is taking shape. A financial network built on open source code, cryptographic proof, and absolute transparency. It is a system that runs on rules, not rulers. A system with no bailouts, no hidden deals, and no central authority that can manipulate the money supply to benefit a select few. The quiet operations propping up the old world are becoming louder. The billions being used to manage stress in the market are a sign of a system that has grown dependent on support. And as that signal gets louder, more people are choosing to explore a new system being built. One with the steady, predictable, and transparent rhythm of the Bitcoin network.